Welcome to the Three Edge Week in Review for the week of January 19th. I'm Fritz Folts, Chief Investment Strategist here at Three Edge, and joining me here once again today is Steve Cucchiaro, the CEO and Chief Investment Officer here at Three Edge Asset Management. And although the news cycle this past week was certainly more focused on Greenland, the European Union, and events at the Economic Forum in Davos, Switzerland, today, Steve and I are going to focus our discussion on the recent sharp sell-off in the Japanese government bond market as investors became concerned about potential Japanese government spending and inflation and the possibility the Japanese government is going to need to issue additional debt to cover the cost of the newly elected Prime Minister Takaichi's proposed tax cuts, which would add to Japan's already enormous debt burden. So I don't know, maybe, Steve, maybe there's going to be the battle between the Japanese Prime Minister and the Japanese bond vigilantes. We'll have to see, and I know you'll get into that. And importantly, I think Steve also will cover that the sell-off in the Japanese bond market also spread, at least temporarily, to the U.S. Treasury market, pushing Treasury yields higher. And so it really had, quite an impact. And Steve will get into all that. Before we get to that, I did want to have one observation about the brief sell-off in U.S. equities on Monday as the tensions ramped up between the U.S. and the EU over Greenland. And what I found interesting was that in the midst of the sharp sell-off in U.S. equity markets, which was understandable, at the time with what was going on, we also saw the dollar sell-off and we saw U.S. Treasury sell-off while the price of gold spiked higher. And so, clearly for one day anyway, the investor perspective of risk off or a risk off trade was away from the US dollar, away from US Treasuries, selling US assets and buying gold. And I just sort of wonder if that scenario could repeat itself at some point down the road. But that is the topic for another day. So let's get back to today's topic, Japanese government bonds. So Steve, we saw this, I guess they've stabilized recently, but that was quite a sell-off that we saw early in the week, and it was described in, I think you've called it a crash, or at least a minor crash. So maybe just if you could explain what the heck happened, why do we see such a kerfuffle in the Japanese bond market, and why did we see it spread to other markets around the world?
Well, global markets are a lot more interconnected than many people realize or talk about. And people might wonder, why are we talking about Japan when all these other headlines are going on? But it's very important because there is a very important tie between what's going on in Japan and the things you mentioned, Fritz, and the potential impact on our bond and stock market. And it all goes back to the fact that Japan had their big bubble in the 1980s. It ended on the last day of 1989. And for 35 years, they've been mired in stagnation and deflation. And to fight the deflation, they drove interest rates down to zero and even below zero for much of that time. And it's only very recently where the rates went back above zero. And because they drove rates so low, the Japanese yen sold off, and it's much more undervalued than purchasing power parity would suggest. It's a very undervalued currency. Well, this has a huge impact on global investing. Why? It's called the yen carry trade. Right. So many investors around the world, in the US and elsewhere, borrow money and have been borrowing lots of money cheaply out of Japan, and using that money to buy our stocks and bonds. Treasury bonds, the NASDAQ 100 Tech Stock Index, AI stocks, all kinds of assets. This has been going on for a very long time. So you've got all this leverage building up. And when people borrow money in Japan, the interest rates were, at some point below zero, or at least close to zero. And when the yen depreciated, it was almost like being paid to borrow the money. They take that money and they put it in U.S. assets that went through the roof over the last several years. And the more they won, the more they borrowed, the more they gained. And this really snowballed into a huge impact. And it's happening all over the world. And so you have to ask yourself, what would happen if all of a sudden it was no longer cheap to borrow in Japan? In the yen, after being so undervalued for so long, started to appreciate back to fair value. Well, what would happen would be it would be like a big margin call
Right.
on all these leveraged investors, and they'd have to sell off their stock and bonds. And this would have major impact, and it's pretty much off the radar screen. It's not really in the headlines very much.
So very interesting. I guess my question is, what is the direct? There is the yen carry trade and the impacts of that, and then how does that translate into its impact on, say, the U.S. Treasury market? You know what I mean? So why did that have U.S. Treasury yields spike?
Well, for one thing, having Japanese bond yields so low act as an anchor for the global bond market, the U.S. market as well as other bonds, because there's only so much a spread can grow between, say, the U.S. bond market and the Japanese market. And it acted as a compression against all the global bond yields. And so when all of a sudden the bond market, the global bond market and the U.S. bond market lost their anchor, and Japanese bond yields, the 30-year bond yield went up to all-time record highs. It's never been so high as it got this week. And the 10-year yield, soared. And of course, that means that when the yields go way up, the principal value of those bonds are crashing and plunging.
Right.
All of a sudden, it takes away that anchor that's artificially holding the rest of the global bond market down. And people worry about this yen carry trade perhaps unwinding. So it is a major impact, and it shows how interconnected the markets are, even though people don't often think about that.
Right. So you know what my next question is going to be. So based on what we've discussed here and the global implications, is there something that investors should do now in terms of their own portfolios based on what we've talked about?
So I have to say that this is a risk. You can think of it as a black swan because very few people are focused on it. But this is the kind of risk that can come out of the blue.
Right.
And we might not have any productivity loss in companies. We might not have any earnings downturn. A lot of things that people focus on might still be going ahead nicely. And all of a sudden, if the yen carry trade starts to unwind, you've got this source of selling that no one has seen in years and years that could come on the market quickly. And it's one reason why we think that the most overvalued markets don't deserve 100% of your money. There are so many people who are tempted to put all their money in the assets that have done best over the last several years, like the AI stocks and the U.S. Stock market companies, the major index contributors. And yet those are the ones that will be in the direct bullseye if this yen carry trade unwinds. So again, we think this is the most important time in a long time to be highly diversified. Don't put all your eggs in one basket. Don't put all your eggs in those assets that would get hurt if the yen carry trade unwinds. And frankly, that's U.S. stocks and bonds. And going back to the point you made earlier, what was the one asset that didn't fall?
Right.
It was hard assets, gold and other hard assets. Commodities did well, other hard assets. And if things do get into trouble, then there's going to be even more pressure on the U.S. government and the Fed to try to come to the rescue. And that's going to weaken the dollar even more. That's going to be even more favorable for hard assets. So that would be my advice.
Excellent. Yeah, I mean, gold is just year to date, it's up a lot. It's really quite crazy. It's almost like this is a warning shot. This is the warning that you should be more diversified because, maybe this particular, spike in yields in Japan didn't turn into a full-blown, disaster in the markets, but it's a warning of what could happen. And again, gets to your idea that the need for global diversification at this point is very high. So
that's a great way to put it, Fritz. That's a great perspective. I like that.
So thank you for sharing that. So that will do it for Steve and me for this week. As a reminder, all our videos are always available on our 3Ed YouTube channel. And please feel free to share them if you think someone would benefit from seeing them. And if you find them to be valuable and would subscribe to our YouTube channel, we'd also be appreciative of that. So until next time, on behalf of Steve and everyone here at 3 Edge, thanks for listening.